Are you always wondering how I'm making these profits each and every time whenever I'm trading? And whenever I set zones, most of my zones get respected. In this video, I break down step by step how I spotted the liquidity grab, confirmed the entry, placed my stop loss, and secured purchase like a pro. And in this video, you will learn what liquidity actually is, how to spot liquidity grabs before they happen, the exact entry model I used to secure 4,800 US dollars, by stop loss, placement, and trade management, how to avoid common liquidity trap mistakes. My goal is to help you trade smarter, not harder. Make sure to watch this video to the end so you don't miss the confirmations that made this setup high probability.
Inside my free Telegram channel, I break down how real VIP trades are planned, how entries are found, and how risk is managed. You get to see how professional trading works before going premium. This is also where you gain access to my VIP channel and full mentorship. Join now using the link in my bio or description.
Without wasting much time, let's start with liquidity grab and then we go deep and I'll show you the real screenshots of the trade that I took, and also we shall look at the real chart examples differently from these lines. Now, the first thing we're going to talk about liquidity grab. Liquidity grab or stop hunt is a market maneuver where large institutions intentionally push prices just past key levels like old highs, lows to trigger stop loss orders and buy sell stops, creating instant buying selling pressure, and that's of course taking liquidity to fill their own massive orders, often resulting in a sharp immediate reversal that traps retail traders who chase the false breakout. Now we are going to look at how liquidity is grabbed in the market, and first of all we also have to look at what really is liquidity sweep. Now a liquidity sweep in trading is when big players like institutions or big banks intentionally push the price past key levels, highs or lows, to trigger stop loss orders and pending orders. Now, I will explain these things deeply. Make sure you watch this video to its fullest so that you can really understand the depth of liquidity and you understand what liquidity means in the market. This takes the pending orders of retail traders, creating a surge of available orders, liquidity, which is liquidity, of course, to fill their own large positions, often resulting in a sharp, quick reversal against the initial move. Now, this is what we're going to talk about. First of all, we can see, if we can see well on this that I've drawn here, we can see that the market is sharply moving to the higher highs. Now, what does the market do sometimes? The market will create what we call inducement areas, what we call traps. Now, most retail traders, mostly those who trade trendline trading or trendline strategies, or these common strategies, they're going to say that if the market is coming back to this zone around here, and they are pretty sure that if the market comes back to that zone there, if the market comes to this zone, they're going to buy because they're seeing something like a sharp move where the market is going to the higher highs, and they're confirming that the market might buy from here. And considering the zone is having maybe double bottom something, all those things, all those statements they make. So what is going to happen if the market doesn't really go up and the market does something like breaking the zone? Now, what do you think is going to happen? They're going to think that now we're going to trade now what we call break and retest. So many people think of these. These are common things that are known by bigger institutions. So this is what is going to happen. Someone is going to think that the market is going to come back and they sharply drop with the market. Now, this is what the market is going to do. Instead, the market is going to do this, comes, grabs liquidity below the zone, and by it moving back, it's not going to stop here like they think. So for them, they're going to enter sell orders from this zone, and they're thinking that if the market comes to this zone, it's going to drop for good and it has changed the direction. Hence, the market is going to do something like this. It's going to break the zone and continues to the higher highs. Now, how do we avoid being taken as liquidity from these trap zones where the market traps us? That's what I'm really explaining now. As we know very well, liquidity is everywhere. We have sell side liquidity and buy side liquidity. To those who don't understand liquidity, liquidity is money, and that money are your stop losses, you retail traders. Now, what is going to happen is that the market is looking for liquidity because liquidity is the motor for the market, or it's the generator for the market. Without liquidity, the market is not going to move and the market is not going to work. Of course. So whenever the market gets liquidity, that's when you see a sharp move. Now, this is what is going to happen. Instead of you being grabbed as liquidity, what if you look for any zone that is having a lot of liquidity and then you wait for that liquidity to be taken and then you take your trade? Let me go to the real chart example, then I show you what I'm trying to mean. Now, like I said, liquidity is everywhere in the market. Everywhere in the market. We have buy side liquidity, we have sell side liquidity. Now, what do I mean by that? We have what we call external and internal liquidity. The first thing that we look at is the direction of the market before we look for liquidity. Now, as we can see, if someone woke up when the market is already moving like this, it has broken with a break of structure and it has tapped into this zone as its main zone because this was a selling market, it was in a downtrend, and the market is sharply showing you that it's in a downtrend, strong downtrend. Now you woke up when the market has already left you, it's already moving down. So what are you looking for? You're looking for the nearest direction at the moment. Now, what is the nearest direction at the moment? The market has this internal buying movement, which is as in an internal uptrend. Now, we are seeing this internal uptrend and we are having some of our confirmations. Of course, what are our confirmations most of the times? We are looking at imbalance. Firstly, we are looking at the break of structure. So we know the direction of the market and we are seeing some liquidity around here and liquidity around here. Like I said, liquidity is money and liquidity are your stop losses, which means buyers who are entering from this zone, they were leaving their stop losses around here and this is liquidity. And others who are entering from here, they left stop losses around here, which is liquidity. And also sellers who wanted to take the market down, they're leaving their stop losses around here, which is liquidity. Now, what are we going to look for? We're going to look for imbalance, which is here. Now, most of the times, people can see imbalance, a break of structure, they see another block, and they think this is the right zone to trade from. And they forget that there is some imbalance not filled before the zone, before this zone was created. There was some imbalance left behind and some liquidity not taken. And what do you think is going to happen? This will be a trap. And you falling in the trap, of course, you will lose your money. Now, this is what is going to happen. For you, most of traders, they will mark these zones. For example, this is my zone and this is what I'm looking for. Now, what is going to happen? The market is going to come, sweep liquidity below the zone and move. Also, the market might come and react to the zone a little bit and then still drop down. Or the market might come, sweep this liquidity and sharply move up. So anything can happen. So what is the safest zone to sit in and you say, you know what, this zone is where I'm going to sit and I'm going to wait. You rather miss a trade instead of losing a trade because we are protecting our capital. And if you don't have capital, of course, will you come back to trade tomorrow? No, you can't because you don't have capital. So if we have to secure the capital, that's the first thing, the first main thing that we're looking at because it's the only way that we're going to make money. So this is what is going to happen. On my side, I'll choose this zone as my zone. Now, this will be my mid-risk zone. Now, sometimes you see me creating what we call risky zones and mid-risk zones. This zone is a risky zone because there is still liquidity below the zone and unfilled imbalance. So sometimes the market is going to come, sweep that liquidity, and then take you out. You know that? So let's play this out and we see what is going to happen. Firstly, let's first look at the size of the zone so that we can know that this is what we're going to lose if we take a trade from this. Now, the first thing that we are looking at is this zone. This zone, if we take an entry around this zone, that means we are risking something like 47, 48 pips. You understand what I'm saying? Now, let's look at this zone here down. This zone around here, if we are taking this zone, we are losing something like 36 pips. But you may increase and you say, you know what? I'm going to put it around here because maybe this internal liquidity might be taken, which is not bad. Now, something is like this. These are all 40 pips, 49, 48 pips. So, which means if you lose the two trades, you're losing something nearly 90 pips. Now, what do we do to minimize that risk? I've said that in my past videos on lower time frame confirmations, but in the coming videos, I'll still explain those things. But right now, we are looking at this way of trading, which one is the right zone, which one is not the right zone because of liquidity. Now, this is what is going to happen. First of all, this zone will be a risky zone. Let me play this and you see. So the market is coming with full force to fill this imbalance, take all the internal liquidity, tap into the zone, but this is what is going to happen. Market comes still with full force, showing you that I'm no longer interested in stopping from there. So some people will take entry after or in the mid of this zone, which means they're minimizing the risk to 26 pips, which is not bad. And this happens. Market sweeps liquidity below the zone. Do you see what I'm meaning now? Market has swept liquidity below the zones, which means you have tapped in your stop loss and boom, the market is moving up. After the market moves up, I think you can see a sharp move. Market moved all the way to this zone, which means market tapped into this order block around here that was created, swept this internal liquidity around here, and then wants to move down. Now, this is why I told you this zone is a risky zone and you may end up losing your money. So why do we wait for this lower zone? It's because at least this zone is a zone after all the imbalance and internal liquidity is taken. So this one will be a trap. So never fall for these traps. These traps are mainly there to take our money most of the times. And when you take a trade from this zone, that means you're going to take some partials, not even full to the recent high. Why? Because we know very well the market is in downtrend and it's breaking to the lower lows. Just that you came in late and you couldn't take a trade from here, then chill. Wait for this zone and then you take a trade. So this is what is going to happen. Market does something like that. Now, what is the market creating? The market is creating more liquidity. As you can see, what do I mean? More buyers are re-entering from this zone, thinking that this zone is a strong zone that is going to push the market to the higher zones to keep on going to the higher zones because they trust this breakout structure, not thinking of the market coming to take the last liquidity around here and even more liquidity that might be around here if the market comes and creates more liquidity around here. Of course, it will be another way of taking another entry after the all liquidity is taken. Now, do you see that? Market is indecisive. It's not showing any direction at all. And this is what happens. Sweeps liquidity above and decides. Taps into this. Now, what is this? This is the first layer of sweep of liquidity. Now, it has swept liquidity, all the internal liquidity that it has been creating around here, and now it's swept by that sharp move. And I think you can see what happens. Now, if the market has swept this internal liquidity around here, sorry, it is creating new liquidity around here. So the real traders wait for a sweep of this zone, because if this candlestick closed like this, not even breaking to the higher highs, bro, this might be an inducing zone. So what do? You just wait for the market to come all the way here and then you take a trade. Or if you took a trade already, that means if you set BE it's going to take you out and then move to the direction it's supposed to be going to. So sometimes you have to be careful in the market. Whatever the market is doing, just be careful. Now, this is what you're going to do. First of all, we are going to start from the mid of the zone because we are taking a trade after all liquidity is taken. So which means our stop loss will be around here, and we have minimized the stop loss from being 49 pips to 36 pips. And now what are we looking for? We are looking for something like this. This internal liquidity around here must be taken. Since we are in a downtrending market, we are not going to go far. At least here would be enough. So 130 pips, enough for us. We are not going to look for any other thing beyond that. It would be even 120 something pips, 120 something like 129, 120, at least 129 pips would be fine. Would be fine because you are risking only 36 pips for 129 pips. So which means you lost something like 20 something pips because you entered maybe in the mid, then you want to bring back your money. So this is what is going to happen. Let's play this out and we see how the market really played out around here. Now, this is what happens. Market comes, taps in the zone. Now it has taken this liquidity around here. So what is happening now? Boom. I think you can see a sharp move. Do you see that? Do you see that sharp move? So you may think this is a small zone or what and what, but this is a good zone to take because you know liquidity is taken, and you know how to play around with liquidity. We don't just trade fair value gaps like other traders do. We just wait for real order blocks where we know that the market is going to react from, and then we take our trade. So I'm going to show you the screenshots of this trade that I took that made me 4,800 US dollars, and that was it. Those are the screenshots, and that's how we made it. The before and after, that's how we made it, guys. That's how we made it. So don't forget to tap on me if you want to learn how to trade, and don't forget to join my free Telegram channel, and also to get access to my mentorship and learn. So these are the things that we do each and every day. The moment you understand liquidity, how liquidity plays out, then you understand how to trade. That's it, and that's how things are done. All right, guys, let's meet in another video that I'm going to be making soon. And let me hope you enjoyed and you understood what I meant with this video. All right, guys, if you liked it, make sure you subscribe to the channel, hit the like button, and also share and also comment so that we can know what next to make for you guys. All right, guys, have a great time.